Welcome to The Explainer. I'm absolutely thrilled you're here today because let's be real, we're tackling something that feels like a massive weight on so many of our shoulders, figuring out how to actually build wealth. Today, we're breaking down a really fascinating piece of source material. It outlines the exact 5 investments a formerly debt-burdened individual used to literally become a millionaire by age 35. Our goal today is super simple. We're going to demystify that path from being deep in the red to holding $1 million in the green, all using a clear step-by-step roadmap.
Look, if you're glancing at the financial landscape right now, you definitely aren't alone if you feel, well, a bit terrified. I mean, everyone tells you to put your money to work, right? But with all this talk of an AI bubble and the stock market sitting at all-time highs, it can feel totally paralyzing. But here's this massive perspective shift from the author. Investing isn't just some playground for people who are already wealthy, and it absolutely shouldn't be the cause of your anxiety. It's actually the cure. It's the exact mechanism everyday people use to actually get rich.
And, if you don't believe me, just consider this number, $100,000. That is the amount of debt the author of our source material started with. Honestly, this completely shatters that old myth that you need some massive inheritance or a trust fund to kickstart your wealth building journey. You can start from absolute ground zero, or, in this case, literally 6 figures in the hole, and still turn the whole shebang around. So when you're starting from zero, your absolute first priority isn't buying real estate. It's investing in your own human capital. Basically, if you're making less than 100 grand a year, your very first job is to pick a high income skill. And there are 3 golden rules for picking this skill. Number 1, it has to genuinely interest you. Doing something you hate every single day, just miserable. Number 2, it needs to be something you can master with about 90 days of intensely focused effort. And number 3, it has to pay well. We're talking in-demand skills here. Think AI automation, conversion copywriting, or maybe video editing.
Now, you might be wondering, why is this so absolutely critical? Well, it's because of what's called the multiplier effect. Let's just walk through this incredible math together for a second. Say you invest $1,000 into a course to learn one of these high-income skills. That new skill allows you to bring in, let's say, an extra $10,000 a year. Over a 30-year career, that's an extra $300,000 in pure income. Now, if you take that extra income and just invest it in the stock market at a historical 10% return, that grows into $1.6 million. No way, right? But it's just the math.
And this brilliantly illustrates the sheer, staggering power of human capital. Think about it. That initial $1,000 investment in yourself didn't just give you a slight bump in pay. It yielded a mind-blowing 164,000% return. Just compare that to simply dropping $1,000 into the stock market right off the bat. Investing in yourself unlocks higher income, which then unlocks more investing, which ultimately unlocks massive wealth. Okay, so now that you actually have the money, you absolutely must protect it from this silent, invisible thief known as inflation. We all feel it, right? I mean, groceries that used to cost $300 a month suddenly cost $500. Money just sitting in your checking account is literally losing value every single year. But when you put your money into the stock market, you're historically growing your cash at a pace that beats inflation by about 7% on average. And you make this money in 2 ways. Capital gains, so buying a stock at $50 and selling it at $200, and dividends, which are basically passive quarterly profit payouts you get just for being a partial owner of that company. But how do you actually buy stocks without completely losing your shirt? Well, there's this brilliant restaurant metaphor for this. Buying individual stocks, trying to pick the next NVIDIA or Apple, it's like going to a restaurant and ordering one massive, super expensive entree. If it tastes terrible, your entire night is ruined. Just ask anyone who lost their life savings in Enron or Kodak. Instead, you want to order the appetizer sampler platter. This represents index funds. An index fund holds hundreds, sometimes thousands of different stocks. So if one company in that basket fails, it's really no big deal because you still have a taste of everything else on the menu protecting you.
The research actually highlights 2 massive sampler platters that act as the perfect foundation for a wealth-building portfolio. First is VTI. That's the Vanguard Total Stock Market Index Fund. It gives you a tiny slice of over 3,500 companies, essentially the entire U.S. economy. And then to make sure you aren't just betting on America, there's VXUS, the Total International Stock Index. This gives you exposure to Europe, Asia, emerging markets, the whole 9 yards. Just remember, whenever you buy an index fund, you got to make sure the expense ratio, the fee they charge you, is well below 2%, because those high fees will quietly eat your compound interest alive. Now, alongside stocks, pretty much everyone tells you to invest in real estate to get rich, right? But direct real estate? That is really not for beginners. Our author shares this literal horror story where a car physically crashed into one of their rental properties. Can you imagine? It took 13 agonizing months to clean up the mess. Being a landlord is rarely that easy passive income stream that those internet gurus are always claiming it is. So what on earth is the alternative if you don't have, say, a $200,000 down payment or the patience to deal with car crashes and broken toilets? The answer is a REIT. That stands for Real Estate Investment Trust. Think of it kind of like a real estate stock. These are companies that own massive portfolios of property, everything from shopping malls to data centers to medical buildings. And get this, by law, they are required to pay out 90% of their rental income directly to you, the investor, as passive dividends. Pretty sweet, right? So using the exact same index fund logic we just talked about for stocks, you can actually buy REIT index funds. The strategy here highlights VNQ for broad exposure to properties all across the United States and VNQI for international properties. That gives you a tiny piece of ownership in real estate from Germany all the way to Japan. You get that passive quarterly rental income of a landlord, but for sure with absolutely none of the headaches. Getting rich is fantastic, obviously, but staying rich is actually the harder half of the battle. So the crucial point is perfectly captured here by the legendary billionaire investor Warren Buffett. He says, rule number 1, don't lose money. Rule number 2, never forget rule 1. Human nature makes us incredibly greedy. We're always wanting to chase the absolute highest returns. But millionaires, they focus heavily on protecting their downside. We really have to balance our high-growth engines with safe, fundamentally boring investments. Enter the shield, bonds. Now, unlike stocks, where you own a piece of a company, with a bond, you're simply acting as the bank. You are literally lending a company money. Yes, your upside is capped. Bonds are definitely not going to 10x your wealth, but they pay you fixed interest every single month, and they are usually collateralized, meaning if the company goes bankrupt, they have to sell off the factory to pay you back first. When the stock market crashes and everyone is panicking, bonds stay incredibly stable. A really common strategy is allocating about 10% of your portfolio as an anchor into bond index funds, like VGIT and VGSH, just to ensure you stay rich when things inevitably go sideways. Now, what's really interesting about this is the sheer asymmetrical upside of a moonshot. Just look at this jump. Back in 2020, Bitcoin was sitting at around $10,000. By 2021, it hit $60,000. That is a 6x return in a single year. That's a moonshot. It's basically a lottery ticket that can fundamentally alter your financial trajectory, but, and this is a big but, it is also highly, highly volatile. Because it's so volatile, most people just do this entirely wrong. They either bet their life savings and lose it all, or they get completely terrified and miss out entirely. The smart way to handle a moonshot is the 5% rule. You never allocate more than 5% of your money to something like Bitcoin. That way, if it goes straight to zero, hey, you're totally fine. But if it goes up 10x, that tiny slice suddenly becomes enough to pay off your house. As central banks keep printing more fiat currency, government-issued money like the US dollar, assets with a fixed supply, often called digital gold, become very attractive hedges. And today, they are super easily accessible through regulated apps like Coinbase, or even standard Bitcoin ETFs right inside your normal brokerage account. When we step back and look at this entire roadmap, the core philosophy here is brilliantly simple. You have to shift your mindset from being a consumer to being an owner. And honestly, the most empowering part of this entire explainer is that you don't need a fortune to begin. You can start investing in your skills, your index funds, or your REITs with just $100. You now have the exact blueprint that took our author from deep debt to a millionaire by age 35. The knowledge is in your hands, the roadmap is clear, and the barrier to entry has quite literally never been lower. So I'm going to leave you with this final critical question to chew on. Which of these 5 investments will you start with your very first $100? Thank you so much for joining me on The Explainer today. Take this knowledge, take action, and I will see you next time.